When interest rates go down, bond prices go up. Now, this might sound counterintuitive, but I'm going to give an example and hopefully it'll all then make perfect sense. So let's imagine Ashley buys a bond for $1,000 and it's paying 10% interest. So every year she gets $100 in interest, and then when the bond matures, she also gets the $1,000 face value back. Now, she buys the bond and she hangs on to it for a few years, and then she decides instead of holding it to maturity, she actually needs the money. So she's going to sell her bond. Meanwhile, interest rates have gone down. So new bonds on the market are now providing an interest rate of only 5% or $50 a year. Now, let's imagine Dan comes into play, and Dan is looking to buy a bond for $1,000. And he can either buy a newly issued bond that's paying 5%, $50 a year, or he could buy Ashley's bond, which pays 10% a year or $100 a year. Now, if bond rates didn't impact prices, he would obviously want to buy Ashley's bond for $1,000 so that he can get double the interest, right? The problem is, pretty much everyone out there that's looking to buy bonds is going to want to buy Ashley's bond over a newly issued bond that's paying a lot less in interest. And the thing is that most people that bought bonds when Ashley did that are paying 10% are probably going to want to hold on to them unless they need the money like Ashley does. So what happens when you have a really high demand and low supply? That pushes the price up. So Ashley's going to be able to sell her bond for actually quite a bit more than $1,000. Now, the exact price is going to be determined by several factors, including when the bond actually matures. But all else being equal, she's actually going to be able to sell the bond at a price being over $1,000 that gives the exact same return as a bond paying 5% that the person would get from spending $1,000 and getting $50 a year, as well as $1,000 back that they would get from paying over $1,000 for Ashley's bond, getting 10% interest, and then getting $1,000 back when the bond matures. Now, the same and opposite thing happens when interest rates go up. When interest rates go up, bond prices go down. So hopefully this all makes a lot more sense to you.